I'm Emily Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, Uber tanks, shares plummeting after hours after missing estimates across the board. What is the path to profitability? We've got full analysis. Plus, crash landing page. Several advertisers tell Bloomberg the software system used to run campaigns on Facebook and Instagram is crashing regularly for hours, if not days. We'll tell you what's going on. And Double Vision. SoftBank announced its second vision fund after its wildly popular first tech fund, how it's shaking up the VC landscape. First, to our top story, Uber out with second quarter results, including a $5.2 billion loss. Sales, bookings, and monthly users all missing estimates. Shares down to the lowest levels since May. Here to crunch the numbers and break down Uber Eats and active users, Mandeep Singh of Bloomberg Intelligence. So, Mandeep, fairly disappointing. What are your biggest takeaways here?
I think the bookings and ride growth look good. It was just a revenue miss, and part of that was related to the use of subsidies in their ride-sharing business as well as food delivery. That's where I think they've been using subsidies for a while. That's where they've been seeing pricing pressure because food delivery is a very fragmented market. But on the core ride-sharing side, I think they are doing fine. It's just the law of large numbers is catching up, and bookings growth of 37% constant currency, to me, it looked fine.
I should add that the adjusted loss was lower than anticipated, $656 million versus the $979 million that analysts had estimated. But monthly users are below estimates, 99 million. The street was looking for more like 101 million. What do you make of that?
Well, the fact is, Uber is a global company. They may choose to, focus on certain regions more than the others. And this, to me, was a small miss. Again, I'm not making much of the rider miss. It's really the use of subsidies that caused the, the big revenue miss. And that's a sign that Uber is more focused on market share gain. We saw from Lyft, they are trying to curtail their sales and marketing expenses. I think Lyft is not going to expand geographically. So Uber is really trying to take market share right now globally, both in ride sharing and food delivery. And that's why you see that.
Well, and Lyft did have what became a positive day yesterday. I mean, they beat across the board. They moved up the lockup period. Investors didn't like that, but shares were up today. Uber's now lost the gains that they made today going into this. Do you see a path to profitability?
I think, again, if you look at their core business, they give better disclosures than Lyft in terms of bookings and core business contribution margin. The core business contribution margin was 8%. So there was a sequential improvement. And what it tells me is, again, if they wanted to make these businesses profitable, especially the mature businesses like the ride-sharing business, they can do it. But right now, they're focused more on market share and really that platform effect in terms of adding new services and, using subsidies to gain market share in food delivery. That's the big one. And I think that's going to help them in the long run.
All right, and we're listening to Uber's conference call happening right now. Bloomberg Intelligence's Mandeep Singh, thanks so much for that instant analysis. Sticking with Uber results, I want to bring in Tom White, analyst at D.A. Davidson, who currently has a neutral rating on Uber and a buy on Lyft. He joins me on the phone. Also with us in Seattle, Asad Hussein of PitchBook. Same question to each of you. Do you see a path to profitability? Asad, I'll start with you.
Yeah, we see multiple ways that management can kind of move towards profitability. We see nearer-term drivers in the form of reducing driver and rider promotions and incentives. We also think that there's things they can do, management teams of both Uber and Lyft can do in terms of reducing marketing expenses and per-ride insurance costs to help move the companies towards profitability in the near to mid-term. Longer term, we see additional upside in the move towards autonomy as being a key component in reducing costs and moving these companies more towards profitability.
Except that autonomy is just so far out. Tom, Dara did say the losses would decline next year. Both Uber and Lyft have indicated the price wars between the two of them are going to subside. But why do you have different ratings on Uber and Lyft? Neutral on Uber, buy on Lyft.
Yeah, first of all, thanks for having me. Look, our neutral view on Uber really just comes down to limited visibility. This is a company fighting a lot of battles on a lot of fronts. And on one hand, they've got the big balance sheet and the scale to probably outlast a lot of the players that it's competing with. But on the negative side, it's reacting and it's responding to a lot of the aggressive promotional activities from some of the ride-sharing players and some of the online food delivery players that it's fighting with. So it just creates a situation where it's harder to get comfortable with forecasting the financials. We think it's probably pretty challenging for the management team themselves to kind of give investors a very clear and specific and precise kind of 12-month view of where the financials are going to be. So our ratings are based on sort of a 12 to 18-month time horizon. We just think that the visibility and the share gains at Lyft in the North American ride-sharing market are kind of tip it over the edge.
So, Assad, let's talk about food delivery, because on the call, Dara Khosrowshahi has been focusing on the competition, not just in ride-hailing, but in food delivery, seeming to indicate that's the super competitive part of the business now. And obviously, Uber Eats has not just the competitors in the United States, but different competitors globally. What's your outlook for Uber Eats and how it can help boost or not boost the business going forward?
Yeah, so I think these quarters' results really speak to just how competitive the food delivery landscape is, not just domestically, but internationally. Uber Eats is competing with a whole host of competitors that are really well-funded. Companies like DoorDash and Postmates that have received large amounts of funding from deep-pocketed investors like SoftBank, who aren't afraid to really go after the market in a big way and seek revenue and user-based growth. But that's to the detriment of profitability in the near to midterm. And that's hurting companies like Uber, which is facing so much pressure from investors to show a clear pathway to profitability. In the near term, we're encouraged by some positive signs we've seen. If you actually look at the take rate, which is the commission that Uber takes on gross transactions within food delivery, we've seen that trend upwards over the past 3 quarters sequentially. So that's something that we're encouraged by. We're also incrementally more positive based on signs of consolidation in the space, with their rival DoorDash acquiring Caviar. We think that's a positive development and one that we are hope to see more of.
Now, Tom, when we talk about profitability when it comes to Uber, a lot of investors will point to autonomy and the future of self-driving cars, which of course Uber and Lyft are investing in. But isn't that just so far off that it's difficult to include it in any sort of near or midterm model?
Yeah, I tend to agree with you. We think, in 5 years, autonomous vehicles in ride-sharing are still very, very much on the margins. So a very sort of select group of specific routes in specific geographies with, very clear weather, not a lot of fog, not a lot of snow. So very much on the margins. And the reality is that, until the technology advances to a point where it can be more broadly and widely deployed, Uber's going to need a heck of a lot more human drivers, not less. And so, that continues to be one of the big challenges, I think, for both of the platforms is, how do they kind of demonstrate a path to profitability by, making sure that drivers are attracted to the platforms, but also making sure that they don't raise prices so much for consumers that it kind of eats into the number of use cases that people use, services like Lyft and Uber for.
All right, well, never short of drama, Uber versus Lyft. Tom White of D.A. Davidson and Assad Hussein of PitchBook. We're going to keep listening into the Uber call and bring you headlines as we have them. Meantime, we do have some breaking news to tell you about. The U.S. is holding off on granting licenses to businesses to supply technology to Huawei. Remember, of course, the U.S. has blacklisted Huawei, prohibited U.S. companies from sending critical technology to Huawei. That includes software, that includes chips. The U.S. was considering granting licenses to certain U.S. businesses to restart sales to Huawei. But now we hear that the U.S. is holding off on granting these licenses. This, of course, after China halted buying U.S. agricultural products. A lot has happened in between, the U.S. labeling China a currency manipulator, and, of course, the trade war between the two countries only escalating. And this is one more ratchet up. We'll continue to follow that story and bring you any updates as we have them. Coming up, Facebook's ad network is creating major headaches for digital advertisers. Is the social network at risk of losing those ad dollars? We'll discuss next. And if you like Bloomberg News, check us out on the radio, listed on the Bloomberg app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. Facebook's ad manager is having technical difficulties. Several advertisers have told Bloomberg that the software system used to run ad campaigns on Facebook and Instagram is crashing regularly, some say every month. And according to advertisers, these outages can last for hours, even days at a time. One said there's been at least a dozen system failures in the last year alone. And speaking of digital ads, the U.S. Justice Department is scrutinizing Google's digital ad and search operations. This as authorities gear up a broad antitrust review of the market power of giant internet companies. Joining us to discuss, Bloomberg Tech's Kurt Wagner and Mark Bergen. And Mark, let's start with this DOJ story because this just crossed. We knew that the DOJ was looking into tech broadly. We didn't know which company specifically, but we could assume that Google was at the top of the list.
Yeah, it looks like they're looking at Google, and they're looking at no surprise at Google's biggest business, which is search and advertising. What we reported today is that this is looking beyond just the usual suspects of characters, of rivals. Yelp, Oracle, News Corp have been complaining about Google for years. It sounds like we have some reporting that the Department of Justice is also now talking to other news publishers, other ad tech industries that have complained more quietly about Google's display advertising business. It's so dominant there, and that they make these claims that Google's been behaving anti-competitively.
And we know that Facebook is being investigated by the FTC, but we don't know yet if Facebook is part of this DOJ investigation.
Not officially, but if they're looking into the broader ad industry, Facebook's number 2 to Google, so it wouldn't be a shock.
So let's talk about these ad outages, which sound pretty awful if you're an advertiser, and also don't sound like they're good for Facebook's bottom line.
No, they're not, and they're really bad if you're an advertiser. And the whole point that I was told is that the reason you do these campaigns is because you want to do them actively. You know, if a certain image or video that you're pushing isn't actually resonating, you want to be able to take that down right away, replace it with something else, or maybe put money behind a different ad that is working. When the system is down, you can't do any of that. So not only can you not start a new campaign, but you can't adjust existing campaigns, and that can lead to people spending money on ads that actually aren't really working.
And it's down for days?
It can be. So leading up to Thanksgiving was kind of the biggest issue I heard. In Black Friday last year, you may recall the week of that, there was a big outage, and it freaked everybody out, right? Because Black Friday being one of the biggest retail days of the year, to not be able to prepare your ad campaigns was a huge issue. And ever since then, they have seen these with more regularity. So that was kind of the tipping point for people, but it can be a long process.
Facebook's statement, we recognize stability and reliability are critically important for the businesses who use our services around the world and apologize for the frustration these issues have caused. They go on to say they're committed to getting better. Mark, put into context for us, obviously Facebook and Google are the biggest players in the digital ad business. What does it mean that, now, of course, you've got the Justice Department investigating the way Google runs the system. Do you think that will impact Google's market share or give Facebook an advantage or not?
The FTC looked at Google years ago and kind of found that they dropped the case. I think we've seen something a lot. The EU has taken a different approach to antitrust, and the EU has turned on this idea of that the behavior affects the market, not necessarily consumer harm, because the idea is that historically in the US, you want to prove consumer harm. It's really Google and Facebook will say we have free products, show us the consumer harm. I think a lot of people are talking about if the DOJ starts to change the definition there, that could be something that actually goes into it has a big effect on these companies. What you see in the EU, and we're still sort of waiting for the repercussions of that, is they force Google to actually change its business practices. And if the DOJ can do that with Google and Facebook, then we might see a change in the market.
Meantime, Kurt, you're also reporting on another issue with WhatsApp flaws, allowing hackers to manipulate WhatsApp messages.
It's a little.
That sounds scary.
Yeah, it sounds a little scarier maybe even than it is. I think of it more as a product flaw maybe than a security flaw. So you know how when you reply to an email, you could go down and maybe edit what the email you're replying to looks like. It's kind of that situation in WhatsApp. You can reply to a message and change what the message looks like in your reply. So it creates some confusion for sure, and especially for a company like Facebook and WhatsApp that's battling fake news. This is not the kind of product that you want to have out there. They're not the kind of feature you want to have out there. But it's a little different necessarily than, you know, hacking in and changing the message.
So perhaps that explains Facebook's response. They say, we carefully reviewed this issue a year ago, and it is false to suggest there is a vulnerability with the security we provide on WhatsApp.
Which is a big deal for WhatsApp because, you know, it's the encrypted messaging service that Facebook likes to tout. And so for them, it's important for people to know that they don't see this as a security issue. But again, this could be a big issue for things like fake news. And if I'm doctoring what a message looks like, that could be misleading to people. And in some parts of the world, that has caused some really serious consequences.
All right. Well, I'm sure it'll be just a couple more minutes before we have more Google and Facebook news. Thanks so much for keeping us updated. Bloomberg's Kurt Wagner and Mark Berg. All right, coming up, Silicon Valley's latest unicorn, Scale AI, has secured $100 million in new funding. How the company is using the investment to teach computers to see even better. Next, this is Bloomberg. Netflix has signed Game of Thrones creators David Benioff and Dan Weiss in a multi-year TV and film deal worth $200 million, this according to reports. As part of the deal, Benioff and Weiss will no longer be producing shows for HBO, where they were showrunners and writers on Game of Thrones for its entirety, and will work on projects exclusively for Netflix. The duo were also reportedly in talks with Disney and Amazon. Well, artificial intelligence companies are spending millions of dollars a year hiring people to teach computers to see. Among their tasks, identifying and labeling photos so software can learn to do the same thing. It's a costly process that can take one employee anywhere from 10 minutes to a couple of hours. The startup Scale AI wants to change up that process. The company's software instead takes the first look at photos before passing them on to humans for review. Already it's attracted big-name customers like Waymo, Cruise, Uber, and this week it closed another $100 million in funding, valuing the company at more than $1 billion. Joining us to discuss, Scale AI CEO and co-founder Alexander Wong. Alex, thank you so much for joining us.
Thanks for having me.
So what are you doing for Waymo, Cruise, and Uber?
Yeah, so what we've done at Scale is built the data platform for AI. So AI is really built on top of data, and these algorithms require billions and billions of examples of labeled data to be able to perform in a safe or reliable way. So what we've done is built a platform that allows these companies to get the data they need to be able to build these algorithms in a safe and reliable way, and then they use the data to build their self-driving cars.
So what kinds of data? What kinds of algorithms are they building using your software?
So one of the big problems in machine learning is perception, being able to fully understand the environment around you using machine learning. So we process a lot of image data, LiDAR data, radar data, map data, et cetera, for some of these companies. And then for other companies, we process text data or tabular data or speech data.
Now, is the work that you're doing going to improve the safety of self-driving cars? Because there's a lot of concerns about, you know, how quickly they can come to market. Even if they work some of the time, it has to be perfect.
Yeah, it's actually, I think even further than that, the work we do is critical to building safe autonomous vehicles, for example, because without the data that we're able to provide to these companies, they actually wouldn't even be able to build algorithms that could perform in any manner that's safe or reliable.
So if there are thousands of human beings that are necessary to do this job now, in the future, how much of their work can AI really take on? Because it certainly seems that there's always going to need to be some sort of marriage between humans and technology. You can't eliminate humans altogether.
Yeah, I definitely agree with that. I think that AI is really about augmenting humans with technology and making them more effective and more efficient using technology. And in particular, I think for a lot of the problems that we work on, where AI plays a really critical role in self-driving or medical imagery, et cetera, you really want to make sure that humans are a part of the process to ensure that these systems are performing very safely and reliably.
So there are companies that are doing or trying to do what you do. Uber just bought a company called Mighty AI. Amazon has its own labeling services. You know, what differentiates you from the competition, and how does the market evolve?
I think one view that we've really taken is how do we solve this in the most tech-enabled way as possible? So how do we use as much machine learning and technology on our side to make the process as efficient and high quality as possible? And I think that's a very differentiated view, actually. Many of these other efforts are much more human-powered than technology-powered.
Do you have a view on which company is going to get a self-driving car to the mainstream market the fastest?
Unfortunately, I can't really comment on that, but
you have a view.
But I think it's very exciting that all these companies have really incredible technology, and it's getting better and better every single year, right? So we're really getting closer and closer to solving the problem.
So I have to ask you, you're 22 years old.
I am, yeah.
You've been doing this for what?
3 years.
3 years. How did you get here at 22?
Yeah, well, I was really lucky. I grew up in Los Alamos, New Mexico, but after high school, I was lucky to be able to come out here to the Valley to work as a software engineer. Mm-hmm. And that really exposed me to, I think, a lot of these problems where AI and machine learning are really core. And I went back to school for a year, and then after that year at school, I dropped out and started this company.
So should everyone drop out?
I don't think...
Is dropping out something you recommend? Parents ask me this all the time.
I think if you know what you want to do, more and more these days, you don't need a degree to be able to accomplish what you need to do. I think people care a lot more about what can you accomplish and what are your skills.
Interesting. All right, Alexander Wong, Scale AI, thank you so much.
Thank you so much for having me.
Stopping by. Coming up, the top story of the moment, Uber shares tanking in after hours after a big earnings miss. We will have more on that next. This is Bloomberg. This is Bloomberg Technology. I'm Emily Chang in San Francisco. Getting back to our top story, Uber out with second quarter results, and they're not too pretty. After hours share still in the red following the company's sales miss and a $5.2 billion loss in the second quarter. On the earnings call, Uber CEO Dara Khosrowshahi addressed how they're handling their competition.
The competitive environment and our position in the ride-sharing space continues to be stable to improve. We will take some of that improvement to continue to lean into our Eats business, where we see plenty of competition and significant capital investment, but incredible potential.
All right, I want to bring in someone who's got comments on the business strategies of both Uber and Lyft. Narissa Brown, an associate professor of accountancy at the University of Illinois. So, Narissa, we sort of expected a big loss due to stock-based compensation tied to the IPO, other IPO expenses. What did you see in these numbers that you didn't expect?
Well, first of all, I had expected them to at least beat the revenue estimate. Just kind of looking at the fact at what they did, kind of in the last quarter, and trying to kind of extrapolate out to say, okay, if they could at least beat the earnings, the revenue estimate for June, to at least continue that upward trend with respect to revenues.
But they didn't.
But they didn't. Mm-hmm. So if you look at last quarter, revenue came in at about 3.1 billion, and then this quarter it's about 2.87. Mm-hmm. So last quarter, there was a big percentage increase compared to the last quarter the year before. There's still an increase this quarter compared to the quarter the year before, but when you look at the 2 quarters side by side, there's a little bit of a dive.
So what does that tell you?
Well, this kind of raises a question of, kind of how are they going to finish out the year with respect to revenue, which is their top line performance metric, especially for, both for Lyft and for Uber and for IPOs that are making, huge losses. Revenue and in the case of Uber, they have their adjusted net revenue, gross bookings, and a number of riders as their other key metrics. And so the question is, okay, what is revenue going to look like for the next, couple more quarters to finish out the year?
Both Lyft and Uber seem to be signaling that the price wars, the sort of irrationality of the competitive environment, incentives for drivers and riders are going to decrease from now going forward. Do you believe that?
Well, I mean, if you look at, for example, Uber's adjusted net revenue number, where they actually strip back out their driver incentives, when you compare the amount of driver incentives compared to the revenue number, it's actually stable. From the last 2 quarters, it's rounding out at 10%, 10 to 11%. And so actually this quarter is slightly lower. It's 10.2% compared to 10.9% last quarter. So there is revenue growth, but it doesn't seem to be necessarily being driven by providing excess driver incentives.
What about Eats?
So Uber Eats, their driver incentives for last quarter actually, tripled, which is kind of interesting. And so the key thing to watch there is kind of overall, their driver incentives seem stable, but when you look at the businesses within their core platform, whether it's ride sharing or Uber Eats, where exactly is the increase in driver incentives coming from? And right now it seems like it might be stable across the board, but when you dig into the numbers, for Uber Eats, it might be actually increasing to generate more revenue on that end.
All right, Narissa Brown, Associate Professor at the University of Illinois. We're continuing to follow more Uber headlines as they come, and of course we'll be watching to see how shares open tomorrow. Thank you so much for joining us.
Thank you.
Speaking of Uber, before going public, the company raised billions backed by TPG, General Atlantic, and even SoftBank's Vision Fund. SoftBank said profits from the original $100 billion Vision Fund jumped big in the first quarter thanks to bets on companies like Slack and DoorDash. Now, SoftBank is at it again with a second Vision Fund that will expand investments in enterprise technology and cloud computing. To discuss, we're joined by Bolt Start Ventures founder and general partner Ed Sim from New York. And in Tokyo, we've got David Chow, co-founder and general partner at DCM. Thank you both for joining us. David, what's your take on Vision Fund 2? Are there going to be enough places for SoftBank to place all these big bets?
Yeah, I think there are. Obviously, the first fund focused on the on-demand sharing economy, and I think they're now going to focus on cloud computing and enterprise software, which obviously have been growing quite well. In 2016, the multiples of revenue for their market cap for example, software as service was about 5x. Now it's 10x, and I think they're really trying to follow where the money is and where the multiples are higher.
Ed, is there a lot of money to be made in enterprise startup investing, perhaps more than in consumer technology these days?
I would say that consumer gets all the headlines. Everyone talks about Uber and Lyft and DoorDash, but the reality is that you can't have any of those companies without cloud computing, without enterprise software, without developer technology. So my perspective would be that if you're in the Fortune 500, you can't be in the Fortune 500 unless you're a technology company. So everyone is investing in cloud computing and developers and engineering, and that's what's driving returns today. I mean, look at Zoom, look at Okta. These companies are trading at 25 to 40x 2019 numbers still. And so I think most people don't know those names, but that's where the returns are going to be in the future as well.
David, as an investor who's made a lot of consumer investments, what's your reaction to that?
Well, I think it was natural. The whole advent of mobile phones and smartphones, I think consumers had access to that technology first, while the enterprise was still, using laptops on their desktops. And therefore, the growth in the consumer side was actually natural. And there's been a lot more business innovations around consumer on the smartphone as a platform initially. And I think now that is getting penetrated into businesses, obviously fueled by cloud computing. And therefore now it's really the turn for businesses to leverage the smartphone and the mobile revolution.
Now, Ed, are there enough places for SoftBank to really place all these bets, even in enterprise? I mean, I've heard some investors complain there's not a lot of great things out there right now.
I would say yes and no. I mean, if you look at the number of $100 million and above rounds that have happened over the last 2 years, I think last year with just the US alone, $130 billion was raised, but half of that was from $100 million and above rounds. So I think the perspective really is the enterprise is different from consumer. You can't just throw a couple $100 million and expect to win. Money is not the competitive advantage. There's money from every pocket of the world. There's public equity folks coming down and investing in private. There's private equity firms coming in and investing, and venture capital firms have scaled up. So, unlike consumer where you can actually throw marketing dollars and see immediate growth, there's a lag time for a lot of these enterprise businesses to increase their sales, for an enterprise to adopt their technology. So my answer would be yes and no. Yes, there are going to be plenty of opportunities, but no, it's not the same effect. Money is not the main aspect of what's going to win in the enterprise space.
Now, David, how has SoftBank and the Vision Fund changed up the traditional VC landscape? I mean, many things in VC were the same for so long, and then you've got SoftBank coming in with a lot of money. Is that changing your strategy?
Well, I think it's been a very positive thing for early stage VCs, because I think SoftBank is allowing some of the early stage VCs to exit. The market has changed over the last 5 years, where much larger late-stage funds have actually prolonged the exit because they expect, they've been paying high prices and they still expect pretty good returns. But I think the Vision Fund fundamentally changed the landscape, because typical late-stage funds expect 2 to 3x over a 3 to 5 year period. And I think what Son-san is doing is going to entrepreneurs and saying, I'm still willing to bet long term, and I'm going to write a bigger check so you can change the competition and beat the competition, and I'm going to stick with you longer. And I think that's very appealing to entrepreneurs. And based on the check size they write, they typically win the deals because the late stage folks are looking for a little bit more short term, and their check size is smaller.
It's great for early stage VCs, great for entrepreneurs, but I wonder, Ed, is there a risk of, with this much money flooding into the system, companies being kept afloat that shouldn't be kept afloat? Absolutely. There's a long lag period, for example, in the private to public markets. And lots of money is not necessarily a good thing. I mean, the difference between $100 million and $200 million, what are you going to hire more sales and marketing folks? So I think too much money coming into a sector means returns will eventually go down. And a lot of times, founders may not do smart things with too much capital. So that is definitely one thing to worry about in the enterprise space, and that keeps me concerned as well. Now, David, you're in Tokyo. There's so much. Sure. Go ahead, David. Respond.
Yeah, I was going to say, on the contrary, enterprise software, you need a lot of salespeople to get to the companies to sell. Whereas consumer, you can use social networking to go grab customers. And I would disagree that you actually do need more money to go acquire customers in the enterprise space, and it takes longer for the enterprise software or enterprise customers to sign on. And so you do actually need more money for certain sectors.
All right, and it's a good thing that Masayoshi-san has that long-term view.
May I interject,
we're going to have to leave it there.
May I interject one piece, though?
Quickly, Ed.
Yeah, sure. So the difference, though, between 100 and 200 million at that scale, for example, I think you can raise a question mark. How much money someone really needs. I think, secondly, the way you sell it today has gone bottom up. So companies are much more efficient than they used to be. So I think it's a balance between both.
All right, we'll let you guys continue this conversation off air. Ed Sim, Bold Start Ventures, David Chow of DCM, thanks so much for the debate. All right, the deal that was, then wasn't, is now once more. Broadcom said it agreed to buy Symantec for nearly $11 billion in cash. Broadcom CEO Hock Tan weighed in on the deal, saying, quote, "This transaction represents the next logical step in our strategy following our acquisitions of Brocade and CA Technologies. The deal is expected to close in Broadcom's fiscal first quarter, ending in January." Coming up, fighting terror online. The White House wants to gather tech leaders to try and solve the problem. We will bring you the latest on a meeting that's been called for Friday. This is Bloomberg. U.S. transportation safety officials have demanded data from Tesla on autopilot crashes, a move that a former National Highway Traffic Safety Administration says may be the start of an investigation into the electric car maker. We will have more on that story coming up on Bloomberg Technology. All right, well, the two most recent mass shootings in the United States have sparked continuing debate about the ways in which people are being radicalized online. According to research by the University of Maryland, more than 73% of the time, social media played a role in helping to radicalize people towards extremist ideologies in the U.S. in general. That's from a study from 2011 to 2016. Compare that to the previous 5 years, where the number was just over 26%. To discuss, in Washington, we've got Michael Beckerman, CEO of the Internet Association, a tech lobbying group that includes Facebook, Twitter, and Google. And in studio, Bloomberg's Sarah Fryer, who covers social media for us. So what do we know about this meeting at the White House scheduled for tomorrow?
It's supposed to be a way to get the companies to come together to talk about how they're going to confront this idea of domestic terrorism. Now, the companies have had a system to deal with sort of international Islamic terrorism for years, and they've really worked on developing a way to share that information about posts that go up, videos that go up, and then they're able to quickly take it down across all of the participating companies. And so it would be really interesting if they come to some kind of conclusion like that. The flip side is the White House has also been on the company's case about anti-conservative bias, and a lot of the rhetoric of the white nationalism, et cetera, has some ties to that kind of rhetoric too, and the worry is that they will end up, censoring things.
Now, Michael, you're actually going to this meeting, and there's been a lot of debate, especially in light of these two recent shootings, about online violence, but also the availability of guns, racism, a lot of different issues at play. What's the argument that you and that these companies plan to make?
So these are horrific crimes that happen in the offline world, but our companies are committed to do an oversized role on the internet to help take down extremist content and take down hate speech, and work with people within communities and work with law enforcement to help ensure that these things don't happen. But as you mentioned, crimes like this have happened before the internet. If you look at global statistics, the United States ranks number 15 in social media penetration, but I think we all know where we rank in mass shootings. But we're happy to be part of the solution and have a constructive conversation with the White House tomorrow.
Now, several internet companies have gotten together to form a coalition to fight terror online, but there's a lot of question about how productive this coalition has been. Take a listen to Congressman Max Rose questioning these companies after the Christchurch shootings. This is what he had to say about that coalition.
I'm getting to the fact that you're not taking it seriously because there's no public building, there's no full-time staff, there were no public POCs until after the Christchurch shooting.
Well, I think
that's what I'm speaking to. How is anyone supposed to think that you all take this collective action problem seriously if you have no one working on it full-time? This is not something that technology alone can solve. This is a problem that we are blaming the entire industry for, rightfully so.
Michael, is this coalition actually making progress?
Yes, yes. Our companies have worked incredibly hard, both independently amongst themselves and with law enforcement and national security agencies around the world to help fight terrorism and help fight extremism and all these other terrible things that have been existing in our society for a very long time. I'm proud of the work they've done. The congressman, I think, is a little bit off base in some of his accusations there. And the work that these companies have done, both collectively, independently, proactively, has made a huge difference both here in the United States and around the world.
Sarah.
The problem is that companies haven't agreed on a definition for what kind of content constitutes this white supremacist, white nationalist extremism, and that would actually be dangerous to take down. I guess I'm curious what the conclusion is about how they'll work together in the future. Facebook talked to me about how they took down things after the fact. You know, when the manifesto went up, they were able to scrub that from platforms, but anything proactive they can do?
Right, and that's certainly the question a lot of folks are asking. Michael, look, you've got the DOJ, we just reported, now looking into Google's ad business. The DOJ, a broad antitrust review into big tech in general. The FTC investigating Facebook. Criticism from the president. Criticism from lawmakers on both sides of the aisle. These mass shootings. What's your job like in Washington these days?
Well, look, our companies certainly are under scrutiny, and I don't think they get the recognition, the credit that they deserve in some of these cases. Are they perfect? No. Can they do better? Absolutely. But these are things that are major problems and huge, complicated questions that we have in our society as a whole. And the companies are doing what they can to tackle them. But some of these things, as Sarah pointed out, is a great point. A lot of the speech and a lot of the content that that people are trying to post to the internet and talk about every single day is First Amendment protected speech. Each platform has a different set of community standards. I think it's perfectly reasonable and right in these circumstances for companies to say, we don't want white supremacists, we don't want hate speech on our platform, and we're going to take it down. There are many that don't agree with that. There's many in Congress and elsewhere who have said that the companies should not take that down and should just, put their hands up. But I think it's perfectly reasonable for a company to have community guidelines and community standards that clearly state that hate speech and white supremacists and all of these kind of violent content that people are talking about are removed from our platform and doesn't have a place on our platform. That's not the case with everybody. When you look at our members, they're good actors. They're working to solve a lot of these very complicated and difficult issues we have. But there are many bad actors out there. You hear about 8chan and some of these other fringe websites that have a very different perspective on it.
The question is, where do you draw the line? A dark line. Okay, Michael Beckerman of the Internet Association, good to have you back here. We'll check in with you after that meeting at the White House and our own Sarah Friar. Thank you. Still ahead, we're going to talk about security. What happens on your iPhone stays on your iPhone, right? Maybe not so fast. More coming up next. This is Bloomberg. Plenty to discuss in the world of cybersecurity coming out of Vegas at the Black Hat Conference. Apple, for one, said it's going to start distributing special iPhones to security researchers to help them discover flaws before malicious hackers do and offer them some money as well. Meantime, a Google security researcher on stage exposed some vulnerabilities in Apple's iMessaging and email. For more on the latest from Black Hat, I want to get to Las Vegas, where HackerOne CTO and co-founder Alex Rice is standing by. So, Alex, what's been the most impactful to you at Black Hat?
It's just amazing to see the increased collaboration between enterprises and hackers, security researchers coming together. You mentioned two great examples there of security researchers from an organization like Google helping a competitor in this space in Apple to point out security flaws, be rewarded for that. And that type of collaboration where we're relying on hackers to find bugs that exist in all software is really powerful in keeping all of us safe.
How optimistic are you about the sort of white hat hacker movement and the ability of good guys to sort of identify the vulnerabilities before the bad guys do, given that there just seem to be so many more and so many more powerful bad actors out there?
I'm completely convinced this is an essential part of building trustworthy software and keeping consumers safe. In the last 5 years, friendly hackers who HackerOne have identified 125,000 vulnerabilities, been rewarded over $60 million by enterprises, tech companies, and financial services organizations. Every one of those vulnerabilities is an important feedback loop into a security process to have one less bug out there that a criminal could take advantage of. And the more we see that type of collaboration occurring, the safer we are. Just in the last year, the number of vulnerabilities have...
Yeah, but before you go, we've got about 30 seconds left, and I just want to know, what do you think the biggest emerging threats are?
It's interesting. The type of things that researchers are diving in today, there was a lot of research into how do we detect and combat deep fakes, which are going to be very dangerous coming to the upcoming election cycle. Researchers are doing research into security vulnerabilities in Boeing 787, something all of us depend upon. Vulnerabilities disclosed in the mobile devices that all of us have there. Really, every enterprise is becoming a software company, and software has bugs, and we need hackers to keep it safe.
All right, Alex Rice of HackerOne, thanks so much. That does it for this edition of Bloomberg Technology. We're live streaming on Twitter. As always, we're listening to Uber headlines as we get them. Stay tuned to Bloomberg Television. This is Bloomberg.